We did see a deal this morning, the Legg Mason deal, but it has been a pretty terrible start to the year for M&A so far. Have we reached the end of that boom?
Look, when we talked at the end of last year, we said that M&A activity is really a function of balancing a whole bunch of different inputs, and probably in 18 and early 19, you saw those lending themselves in favor of deals. I think what you've really seen is a shift towards the end of 19 and early 2020, where a couple of things have been added to the overall scale that really are tilting against M&A activity.
You're one of the few people actually who came on and was bearish and willing to be bearish on the record, saying you thought this year was going to be a slowdown year. But what has changed? Because we had these exogenous factors last year. We had Brexit, we had the upcoming election. The only new thing seems to be coronavirus, which on its own doesn't seem enough to really tilt against deals.
Right. I think that's a fair characterization of coronavirus, Brexit. I really think the two things that stand out as the year rolled in were the election. And yeah, the election was out there, but it's become a real and present issue. And I think what's unique about the election this year is that most of the times heading into an election, and the same was true in 2016, before we saw what the Trump platform was going to look like, was everyone's usually within 10, 20 yards of the midfield. And you can deal with that risk. What we're really looking at this year with Trump and now Sanders leading in the polls is a possibility of a really divergent outcome, maybe 10-yard line over here and 10-yard line over there. And I think markets and deal makers are pretty good at pricing and assessing spectrum risk. I think binary risk, where you're really talking about a yes or no answer, that's much more difficult to price in a deal environment.
Well, what's that done to the pipelines? Because if that is true, then obviously going into that sort of back end of the year, it would suggest that no one is going to announce deals.
Right. I think that the hope is that the first year will make up for what's probably going to be a riskier second half of the year. But as you said, it really hasn't played out that way. I think there are a lot of deals in the pipeline. All of us, the bankers, the lawyers, and in fact, and our clients, most importantly, are looking at a lot of things. But the translation from the pipeline to the headline, that's not happening as quickly and as often as you'd like.
How often does it usually happen versus how often it's happening right now?
Probably gross generalization, but I think probably you'd say historically it's 40 to 50%. You work significantly on a deal and it becomes a deal. I'd say you're probably looking now more at the 25, 30%. And that accounts for the difference in what you're seeing in terms of headlines. And
another factor in this market is we've seen sort of much longer regulatory processes, although we should note the T-Mo Sprint thing looking like it is finally going to happen now should be a boon to the market, because it shows that, you know, these big processes that get tied up with antitrust are actually going to go through. Is that a positive, or is just the length of time going to act as a drag on M&A?
Right. Look, the outcome on T-Mobile and AT&T Time Warner, those were great. And if you looked at the outcome in isolation, that's a positive for the market. But I think the tortured path to get there is something that's really causing second thoughts at the outset of the process. Because if you knew going in that you were going to face 24 months and multiple lawsuits, the feds were going to be done, the states were going to jump in, then the California Commission was 7. I'm not sure that people would necessarily have the same appetite to do those deals. So notwithstanding the positive outcome, I certainly think it's another issue that's slowing down people from jumping into those deals.
But what can companies do to mitigate that risk? Because if you're going into a deal knowing that potentially, you know, it's 2 years before you're going to be able to close it, how do you, as an acquirer and indeed as a seller, mitigate that?
I think it's going to take more thought, more time, more negotiation, and none of those are positive for deal activity, because you used to be able to have a confined set of issues that you had to negotiate around. Of course, there were always the corner cases, but people were able to overlook those corner cases and say, I'm going to focus on the most likely outcome. There's been enough uncertain outcomes, unanticipated developments, different remedies, that now people at the outset have to sit down and actually think them through and actually allocate risk around those. And when it's such an unexpected outcome, it's very hard for the parties to reach a meeting of the minds. And so I think those deals, those strategic overlap deals, may be harder to print, notwithstanding the positive outcome on the two high-profile ones.